Hello everyone and welcome to my channel Fiscal Voyage. I'm Felix and we're going to do a stock analysis on Occidental Petroleum Corporation. This company was recommended by Ho Yun T. Uh, Thank you T for suggesting this company. If this is the first time you visiting my channel, leave a comment below so you could suggest a company you would like to see analyzed next. So with that, let's start. Um, we're gonna do a 5 minute stock analysis of the company to determine if it's a buy, hold, or sell right now. All right, let's start with the 5 minute stock analysis on Occidental Petroleum Corp. You can find it in New York Stock Exchange as OXY. The company is an American company engaged in hydrocarbon exploration in the United States, Middle East, Colombia, as well as petrochemical manufacturing in the United States, Canada, and Chile. It is organized in Delaware and headquartered in Houston. The company is ranked 722nd on the Forbes Global 2000 and 220th on the Fortune 500 company list. In 2018, the company was the ninth largest petroleum producer in Texas. All right, let's look at the fundamentals. The company revenue grew at a compound rate of 1.54% from 2009 to 2018, which is not great. It's very low. Net income grew a little better at 3.95. Currently have a credit rating of A, which is investment grade, but I think they may be downgrading it, so we'll see going forward here. Operating income just grew at a 0.30% rate, which is extremely low, and earnings grew at a decent rate of 4.65%. However, the past 5 years, revenue has been negative, net income has been negative, and earnings 5 year average has been negative as well. If we look at the fundamental, last year the company had adjusted earnings of $5.01. Net margin came in at 23.08%, return on equity at 19.64%, debt to cash a decent ratio at 56%. Currently, the company has a great dividend yield at 8.41%. That's nice yield. But however, they have a huge payout at 161%. So it looks like they're using debt to pay off or to pay the dividends, which is not good. I don't like to see this high payout ratio. They have been growing dividends for 17 years consecutively, and with a 5 year growth rate of 4.77%, which has been decreasing because the most recent dividend increase was 1.3% in July of this year. So that doesn't look very promising. They may even freeze the dividend or possibly cut it with that payout ratio. So that's something that I don't like here. The dividend, however, has a 5 year yield average of 4.59%. So basically almost double right now with the current yield. They have a charter rule of 13.18, which is the current yield plus the 5 year growth rate. However, like I mentioned, that growth rate is slowing down tremendously, so that'll be interesting going forward. The future outlook for 2019 fiscal year, they're expected $1.94. However, last year they had made $5.01 per share, so it's much lower than previous year, and in 2020 it's expected to be lower than what this year earnings is. So that's not good. I don't like that at all. I like to see earnings growing consistently every year. CFRA does not have a earnings projected growth. A lot of analysts expect negative earnings growth for the next 3 years. My dividend drill return model estimates came in at only 5.2% return going forward, which is mostly on the dividend yield side. That's if they continue paying out that dividend at over 8%. So based on valuation and the earnings, you're not getting return there. Your most return is going to come from dividends, which is not something I like to see there. They currently have a PE of 17.77 and with a forward PE of 30.58. This tells me that earnings are projected to be much lower than currently. And they have a 5 year PE average of 68, which is very high. All right, let's look at the fast graph. You can see here the black line represents the monthly closing price, the blue line is the normal PE, and the orange is the earnings PE of 15. As you can see, it's right between the blue and orange, but you can see their earnings are expected to be lower for 19 and fiscal year 2020, and should be picking up by 2021, but no one could really see that far. This graph is, like I said, it's not something that I like. So let's look at the fair value. CFRA has a fair value of 19.51 cents. Morningstar at 45, Fast Graph at 27, Yahoo at 50, and my dividend discount analysis at 35. We get a fair value price averaging out to 5 at 35.61 cents. And currently, the company is almost $2 higher at 37.57 cents. So it's overvalued by 5.21. So with that, I recommend it as a hold, actually not a sell, because the company has a good history of maintaining the dividends, 17 years of consecutive growth. However, I don't like the yield, not the yield, but the payout ratio over 100%. The yield is outstanding, over 8%, but they're using debt to pay these dividends, so that's not good. I personally am not buying this company, so I wouldn't recommend it. It has a lot of things going on. I would like to see maybe another year or two of earnings to see how it's going before I even consider it as a buy. But for now, it's a hold. If you have the company in your portfolio, just continue holding it and receive the dividends, and have the dividends go somewhere else with a company that's growing. But right now, it's a hold. Like I said, I like the dividends, but I don't like the payout ratio. So that's my recommendation for this company. If you have a company that you would like to see next, please leave a comment and let me know the name of the company and the ticker symbol. Thank you for watching. If you find this video informative, please hit the like button and subscribe to my channel for more videos like this. Also, you can check in the description. I have a link to my portfolio. And don't forget to look at my website, fiscalvoice.com. Have a great one, guys.